We have a special guest, Mr. Mohnish Pabrai, to kick off our ideas this year. Mohnish is a highly respected value investor. He's an author. We have his books here. He's a philanthropist. I'll talk about it a bit. And the founder of Pabrai Investment Fund. Mohnish is a YPO Gold member in Austin. He's originally from California. He transferred in when he moved to Austin in 2021. And the way he started his entrepreneurship journey is in 1991. He borrowed heavily on his credit card debt, almost draw down $75,000, and completely borrowed from his 401k to start his first IT consulting business. He grew that to 20 million and sold it in 2001 during .com bubble to a company called Salmon Associates. So he is a hustler, he is a salesman, he is founder. Today he's a managing partner at Pabrai Investment Fund. He modeled it on the Berkshire Hathaway and Buffett partnership model of 1960, which when he shut down in 1970, if my memory serves me right. However, the most meaningful thing about Mohnish is he's a philanthropist. In 2005, he started Dakshina Foundation. Without much further ado, let's welcome Mohnish Pabrai.
Okay, it's great to be here, and thank you for having me. And I had a very long 5-mile commute to get here. So anyway, it's always a pleasure for me to speak to YPOers. This is my 27th year in YPO. I used to have a head full of hair when I first started, and gradually that all went away. I think, like many of you probably know, that it is absolutely true that the more you engage with YPO, the exponential the payback. So it actually changed my life in more ways than I can count. So it's been a great organization, a great journey for me, and some, just obviously tremendous lifelong friendships. So I'd like to start with a story. Maybe we'll talk about 2 or 3 stories, and then we'll see what you guys want to talk about after that. So in 1626, there were some Dutch settlers in what we know today as the island of Manhattan. And actually the Indian name for it is Mannahatta. They kind of tweaked it to Manhattan. And the Dutch wanted to buy the island from the Native Americans. And they had a guy, their negotiator, Peter Minuit, who was a trader. So they sent Peter to make a deal with the Indians, and the deal was done for 60 guilders, which is about $24 at the time. So for basically $24, the Indians handed over the rights to the island of Manhattan to the Dutch. And when people hear that, they say, well, the Indians kind of got taken, because you look at it was very prime land and great natural harbors and all of that. If the Indians had a, let's say, trust officer or investment manager who was going to take this $24 and invest it for the benefit of the tribe, and let's say the guy wasn't that great, but could do maybe 7% a year. We have something known as the rule of 72. Some of you might be familiar with it, maybe. Who's familiar with the rule of 72? We have a couple of folks. So the rule of 72 is a very easy way mentally to understand how long it takes for money to double. So if I have a 7% rate of return, I can just do 72 divided by 7. It's approximately 10. So you would just say it's 10 years. And if I were, for example, getting a 10% return, if I do 72 divided by 10, it's 7. So it works pretty well for a pretty large range of percentages. So it's a good back of the envelope way to understand, what different interest rates will do in terms of, building wealth over time. So if the Indians were getting a 7% rate of return, every 10 years, that money would double, right? So 1636, it would be $48, and 1646, it'd be $96, and we'd keep going, right? Now, if you do 10 doubles, that's 2 to the power of 10, right? So 10 doubles would take 100 years. So every 10 years we're doubling. If you go for 100 years, that becomes 2 to the power of 10, and 2 to the power of 10 is 1024. So again, because we want to keep the math simple, just throw away the 24. So basically, 10 doubles at 7% means whatever you started with, you would have 1,000 times that. So if you start with $24 in 1626, then by 1726, it's 24,000. It's 1,000x because of that 7%. And 1826, it's 24 million. And 1926, it's 24 billion. And 2026, it's 24 trillion. And now we are 2023, we're not 2026. So I'd say take about 23% off. So maybe around 20 billion, 19 and a half, 20 billion, 20 trillion is where Indians had invested it. They would have about 19 or 20 trillion. And so then, you ask, well, would the 19 or 20 trillion be more than undeveloped land in Manhattan? So the entire wealth of the United States, every man, woman, and child, everything we have, is about 150 trillion. So it's unlikely that just undeveloped land in Manhattan would be 1/8 of that. That's not likely. We've got plenty of other things in the country. And there's another way to kind of do this. Basically, Manhattan is about 626 square miles. And when you convert that to square feet, you basically, today, if you were buying pretty prime land in Manhattan, you'd pay about $1,000 a square foot for it. And this works out to something like $32,000 a square foot. So basically, the Indians got overpaid at $24. Okay. And the screw up was that they didn't invest it properly. So one of the things about compounding is that Einstein called it the eighth wonder of the world. And the reason it's the eighth wonder of the world is that we are not used to thinking exponentially. We're used to thinking linearly. But compounding doesn't work linearly. It works in a kind of a log scale. Getting your arms around that concept, it's a simple concept, but it takes some thinking to get around it. And if I take another story, when Columbus sailed for America, 1491, it's rumored that Queen Isabella, she was a great venture capitalist. She funded him with $30,000 for the voyage. And if we leave aside the psychic benefits of finding a new hemisphere, people would say, well, that was a tremendous return on the 30,000 that, found the Americas, right? But if we take a even lower rate of return than the 7%, so let's say that 30,000 was on a 5% rate of return. And so if we take the rule of 72, 72 divided by 5 is approximately 15. So the money would double every 15 years. And 1491 to 2023 is 532 years. A little more, 532 years. So if we do 532 and we divide that by 15, it's approximately 35. So what that means is that we had 35 periods where the money would double, right? Basically, so you start in 1491 with 30,000, and in 1506, you would have 60,000, and then 1521, you'd have 120,000. You keep going. So 2 to the power 35 is 2 to the power 10 times 2 to the power 10 times 2 to the power 10 times 2 to the power of 5, right? You could split it up. So that's 1,000 times 1,000 times 1,000 times 32. So that's 32 billion. If you started with $1 in 1491, you would have 32 billion today. But she gave him 30,000. And 30,000 at the 5% compounded that's about 1,000 trillion. And the entire wealth of planet Earth is 500 trillion. So even Queen Elizabeth, Isabella, didn't get a great deal. She gave Columbus too much money. And he didn't, even though he found the Americas, he couldn't make it happen. So, there was a newspaper article a few years back where they said that there was some janitor who worked at a college all his life, very basic salary, etc. And people were surprised that when he passed away, his estate had given $4 million to the college as a gift. And so they all reported like, wow, this was a huge gift. And this guy he's never ran a business or did anything. But actually the 4 million, because the journalists are not mathematically astute, is actually not a big number. The number should have been much higher because he lived a modest lifestyle. And when my younger daughter was 18, she got a summer job just before she started college. And she saved about $5,000 from working in the summer. And so I told her, listen, the law allows you to put the entire $5,000 in an IRA. And if you trust me and you give me a power of attorney on that IRA, I can do some things with it. She said, yeah, whatever, that's fine. So we opened an IRA and she gave me power of attorney on that, managing that account. And I told her, listen, because you're so young, we can concentrate very intensely. I could put it in one stock, for example. And she went to school at NYU, so I used to pick her up in California, 1 or 2 in the morning, and usually driving home 40 miles from LAX. So I said, okay, this is a good time to teach her lessons on compounding. And so I said, that 5,000 that you gave me, if we get a 15% return on that, which is higher than the index, but let's just bear with me for a second. Rule of 72, I told her you would double every 5 years, and you're 18. So I said that, what would that money be at the age of 68? And I pull all these numbers out to make all the math easy for me. So from 68, from 18 is 50 years. Lo and behold, it's 10 doubles. Lo and behold, we know 10 doubles is 1,000. And so you start with 5,000 and you're at 5 million at 68. So suddenly she's wide awake. She says, whoa, how did that happen? Okay, what I did, repeat everything again. So I repeated everything again for her, right? And so I said, but you're going to be 19 and you're going to have another summer job. And we hope you'll also save some money and we'll put it in that IRA again. And at 69, there'll be another 5 million. And now you're at 10 million. And I said, at some point, you're going to graduate, get off my payroll. That might happen when you're 22 or something, and you might save 10,000 in a year, not 5,000. And maybe at some point, you're saving 20,000. And so I asked her, I said, when you're 70, how much money are you going to have? And she said, my head is about to explode. She said, it's too big a number. So the janitor at the 4 million, we shouldn't be surprised. But the funny thing is that people end up, I think when you look at the statistics of how much people have on average in IRAs when they turn 65 or 70, or how much they have in 401ks, it's a pathetically small number, right? For the country, you look at the averages, it's I think the IRA average is maybe 150,000 or something. It's a small number for someone who's been putting money away for their whole lives. And I think the reason for that is, so if we go back to these dynamics of these rates of returns and these runways, so Buffett was asked one time that, look, if a genie shows up And the genie says, Mr. Buffett, you're like such a good guy. I want to give you any wish you want. So Warren says, I only want one wish. He says that when they look at my corpse when I'm dead, they should say, man, he was old. Okay, and he doesn't want to live a long time because he likes to hang out with us. He just wants a very long runway of compounding. And that's all he cares about. So in his case, his compounding journey started at the age of 11. Warren had, I think by 12 or 13, he had figured out the rule of 72 and compounding and all of that. And so now, he was born in 1930 and he just turned 93. So he's been running that compounding engine for 82 years. He ended up the richest person in the world quite a while back, but he's been giving away a lot of his money, gives away 5% of the total for quite a few years that's been going on. If Warren had not given away any money and just kept everything until today, he'd be the wealthiest guy today by quite a distance, even ahead of Elon and ahead of the LVMH guy and all of that. And so basically with compounding, there are three variables that come in, right? So there are really three numbers that matter. It's the starting amount. We saw the starting amount with the Indians and with Queen Isabella and so on. It's the length of the runway, right? And it's the rate of return. And these three are interchangeable. So what I mean by that is that if I had 10 years and a 7% return, or if I had 7 years and a 10% return, the end number is the same in both cases because of the rule of 72. So you can interchange the rate of return with the duration, and you can get back and forth on that. And so when we look at kind of, okay, so, we have a lot of entrepreneurs here who've done very well, very successful. It's really important to take something, I wish this event was not with you guys. Problem is, half your runways are gone. I'm talking to you at the wrong time. It needed to be a YNG event. The YNG guys I can do something with, okay? So when you have a YMG event, let's have me back.
Absolutely.
Because this crowd, I already lost so much of the runway, it's useless, but the YNG crowd, they're all gonna live to over 100 and maybe over 110 or 120. 100-year runway. What could be more orgasmic than that? That's like the ultimate situation. So basically, if you have a very long runway, like Isabella or the Indians and so on, then obviously very small amounts to start with, and even relatively small rates of return ends up with a large number. But if you take a normal human lifetime, our lifetimes, we start at, let's say, 18 or 20 or 22, and we go till 80 or 90 or 100, you get a 60 to 80-year runway. That's a good size, because if you take the S&P, which has done about 9% a year for the last 100 years, basically 72 divided by 9 is 8, right? So if we're in the S&P, we are doubling every 8 years, right? And what that means is that if you have a 60-year runway, then it's like 7.5 doubles. It's all about the number of doubles. That's all that matters here. So 7 doubles is 128, and 8 doubles is 256. So 7.5, maybe like 150. So whatever you start with, you have 150x that where you end with. But since you're adding to your savings every year, that number keeps increasing. So basically, it would dwarf, in many cases, what might be a great exit at some point in your business, because the exit might come when you're 50 or something, reduced runway time, whereas the savings have been going on for 30 years. So basically, the game, and I think why do people not end up ultra wealthy is they get in their own way. So Charlie Munger, Warren Buffett's partner, one of his best quotes is, never interrupt compounding unnecessarily. Okay, so don't interrupt it. So what that means is, if you're in an index, we don't care about the market. We just dollar cost average every month, the savings are going in, and it's irrelevant what's happening to the market or economy or whatever. We just keep on that program. And most humans are not like the janitor. They're not able to stay with the program. They are too smart for their own good. The other thing about investing is it's a very strange industry in the sense that people who pay the lowest frictional costs win. So the richer you are, rich people like to think that they have got some exclusive guy, some fund manager, some hedge fund guy. Very bad idea. That guy will get rich, skimming off the top. And if you bought the Vanguard, S&P ETF, your frictional costs are like 5 basis points a year, 0.05%. If you're at some hedge fund or something, it's like 1 and 20, 2 and 20 or something. Most of them after fees are going to be behind the S&P. And so even a 1% or 2% or 3% delta in returns, if the 9% goes to 7% or 6%, over a few decades will be a massive delta, as we've seen with. So it's an interesting field in the sense that Joe Public has an advantage over the YPOers because Joe Public has no access to hedge funds. And Joe Public is forced to go to Vanguard and buy the S&P, and then Joe Public ends up ahead. So please be like Joe Public. But the other thing is that, don't be like Joe Public, where Joe Public leaves his job and goes to Hawaii on a vacation with the 401k before starting the next job. Don't do that. Never interrupt compounding unnecessarily. When I started my first business, I was 25. I pulled 30,000 from my 401k. That worked out in the sense that, in the end, the exits and all were fine. Generally speaking, taking those tax-deferred assets into consumption is not a good idea, not to mention the penalties and all of that. So that's my message to you, is basically keep it simple. Vanguard S&P, modest lifestyle, and max the savings. And try to stay healthy. So the runway is long, but since you guys are mostly over the hill, focus on getting this message to your kids. They still can be salvaged. We can do stuff with them. And maybe get them to get jobs when they're like 13 or 14, because the IRA actually has no minimum age. So you can actually start the IRA when you're 3 months old, as long as they made the money. So you got to make sure they make the money. It has to be earnings from wages. So try to figure out some gig that they can work on when they're like 2 years old, and get the compounding started early. So maybe we can talk about what you guys want to talk about. Thank you.
Thank you, Mohnish. I think your speech reminds me of a Charlie Munger saying, take a simple idea and take it seriously. I think most of us forget taking the seriously part. Having said that, I'll open up for everybody Q&A, and I have one question to begin with. why do we have to delay gratification to make our grandkids rich when we have only one life? And why do we have to think about the scale where we are making our grandkids trust kids when we can actually live and have a meaningful life and a rich life, where it's not just about wealth, but it's also about experiences and relationships, friendships.
Sure.
So,
Well, the good news is that since you're YPOers, you can walk and chew gum at the same time. And so you don't need to delay gratification. You can gratify yourself all you want and still have a compounding engine running at the same time. You don't have to make a choice. And the other piece we didn't really talk about here is that large inheritances do more harm than good. One of the best exercises I had in YPO and Forum, I think this was maybe around close to 20 years ago, maybe 18, 19 years ago, is that, and some of you might have done this, is a eulogy exercise. Have you guys done the eulogy exercise? You guys might be too young for that. But it's coming. The eulogy exercise is coming. So basically the exercise was, we were on a Forum retreat, I think some beach in Mexico, and we were supposed to prepare this before we left, and it was like, the exercise was that yesterday you died, and your best friend's going to deliver your eulogy at your memorial service, and write the eulogy as if you're your best friend. Assume that you were one day shy of your 80th birthday when you died. And I remember when I did that, I've done the eulogy exercise a few times, but at that time I was 40, and so I knew what happened in the first 40 years. I had no idea what happened in the second 40 years. So I had to kind of extrapolate and thinking, okay, how many grandkids do I have, and what's going on, and where am I living, and all these things. And so we all sat around a fire on a beach in Mexico, and we basically had about 5 or 7 minutes each, and we each read out our eulogy with no processing in between. And then we all went for dinner. And then the second part of the exercise was that if something didn't make it into your eulogy, why are you spending time on it? Right? So basically kind of forces you to think about what's important and not important. So we spend our time on so many unimportant things. And so that was a powerful kind of a message. But one of the things I took away from that exercise, and I got some of this from, there's a guy who passed away recently. You might, I don't know if you saw the news on that, but have you guys heard of Chuck Feeney? So Chuck Feeney, there's a book which I think is a good book to read. It's called The Billionaire Who Wasn't, and it's his story. So Chuck Feeney was a very successful entrepreneur. His first business was in the duty-free shops. Those are like, the 90% margin business anyway. So he made a few $1 billion on that. Then he started General Atlantic Partners, which is a top flight venture capitalist fund. And basically, Chuck's objective was that when he passed away, he wanted to pass away with zero. Over his lifetime, he gave away, I think, about $9 billion. And he also tried really hard to give it away anonymously. So whenever he gave the money, many places when he gave the money, they had no idea who the donor was. Or in most cases, like if he gave a lot of money to Cornell, that was his his alma mater, and made them sign contracts they couldn't disclose it was him, and so on. And so most of the giving was anonymous. In the end, so he just passed away about a month ago. In the end, he moved to San Francisco with his wife. He had a rented apartment, and he was left with, I think about 6 years ago, he was left with $2 million. And he basically was winding that down. And I don't think he died with more than a few $100,000. So anyway, Chuck's my hero. I like Chuck. And so I had a talk with my kids a while back, and I said, the large inheritances are just not going to be helpful to you. And both actually are completely on board with it. they're not looking for anything. And actually I got divorced about 4 years ago. What my ex-wife and I had done is every year we used to max the gift to the kids, the UGMA accounts, and the maximum gift you can give is 17,000, whatever. And of course that I used to invest that, and it was very concentrated. So they actually got a few $1 million when they turned 18. The good thing with the UGMA is that you got no lawyers. It's an act of Congress, but the kids get full control at 18. And I wanted them to have full control at 18 because my perspective was that if my wife and I had not transferred values till they were 18, trying to say you're going to get so much at 30 and so much at 40 and all of that was nonsense. So at 13 or 14, I told them that when you get this money at 18, you can buy Ferraris, you can buy drugs, you can do whatever you want. You have full control. And in both cases, what they did was at 18, they just turned it over to me to manage. They didn't touch it. And my idea was that this would take care of their college, but we were doing well, and we could take care of their college, so the money never got touched. And they're actually now using it. My daughter's using it because she's an entrepreneur. The other one basically didn't want us to support her. She wanted to pursue a PhD, so she used that for some of her beyond normal graduate level standard of living. And so actually they did better than what I thought they would do. And so I said, okay, you got the money, then what's left? I just like to play math games, So I play bridge, I play blackjack, I play compounding games. And so there's two games I'm playing. There's one game which is compounding the money, and I have about 900 million of other people's money that I get overrides on, but I get overrides in a nice way. I have no management fee, so 1/4 over 6% comes to me. So my investors and I are on the same page. They all like that. So anyway, the thing is that there's a compounding engine, which I am focused on, and then there's a giving engine. And so far, Dakshina, we've given away about 30 million. And my objective is that, so I'm going to die on June 11th, 2054. And on June 10th, 2054, I want to be down to $100. And we'll see if we succeed, but we're going to try. So basically, there's one game of growing it, another game of giving it away, and also I don't want to give it to Red Cross. I don't want stupid things happening with the money. So one of the things about the giving has been, which actually worked out better than I thought, is that it has very high social returns on invested capital. So it works well both ways. So I would say, to answer your question, you can walk and chew gum, you can enjoy life, but don't plan on large sums. It's not a good idea. Other questions? And you can blame me. Just tell your kids there's this Indian guy with a mustache, he told me. It's not me.
I'd love to hear more about your story and your background and how you got to where you are right now.
Okay, well, maybe there might be another event. Well, I think one of the things I've always tried to follow in life is that if on Monday morning I'm not excited to go to work, I do two things. Number one, I don't go to work. And number two, I hit the reset button. And it happened 3 times in my life when I had to hit the reset button. And each time was, going into the abyss, but it led to greater growth. And so I was an engineer working at a tech company and getting very bored. We had shipped the product. They didn't really have much for us to do. And I switched from engineering to international marketing within that company, which was tremendous. Just a lot of learning and growth. And then again, a couple of years after that, that was kind of plateauing out. And I left to start my own business. So that was the second reset. And then in around 1999, so I heard about Warren Buffett accidentally in 94. I was 30 years old at the time. And when I read about him, I said, there were a couple of big epiphanies for me. So I'd never, gone to business school or invested or bought a stock or any of that. But what really surprised me about Buffett when I read about him in '94, because the first couple of biographies on him had just come out, is that basically the framework he was using to make investments is the exact same framework we use as entrepreneurs. The framework to making investments in the stock market and the framework I would use, for example, when I was running my IT business to figure out, okay, where do I want to invest the excess capital? I'm looking at the highest return, lowest risk possibilities, right, in the business. That's what all of you are doing. And so actually, Buffett has a quote. He says, I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. So he had this very business approach to investing, which made a lot of sense to me. And at the same time, what I noticed at that time was that I didn't know there was a hedge fund industry, but I knew there was a mutual fund industry. When I looked at the mutual fund industry, I saw that these mutual funds had hundreds of stocks. They had like 80% annual turnover, and they were violating all these basic framework rules of Ben Graham and Warren Buffett. And so I said, it's really strange, you kind of have like people who say that I don't believe in gravity. So whether you believe in gravity or not, it's going to affect you. So I had a theory at that time that if someone who had no investing experience applied Buffett's framework to investing, that person should do better than the 90% of yo-yos running funds. And an idea is like an asshole. Everyone has one. It doesn't mean anything. So I had sold a small portion of my business at that time. I had about $1 million after taxes and everything. So I said, okay, I'll take the $1 million. I'll invest it in the public markets, and I want to see what happens. I want to see what I can do. It went really well. I think in 5 years, the $1 million was 13 million. It was like north of 70% of a year. And so I said, well done, Mohnish. I knew you could do this. And so I was more and more interested in investing and compounding, less and less interested in running an IT business with 170 people. And my job turned into basically herding cats. You know about herding cats. I think you're like every day herding cats. And so I said, I don't want to herd cats. I'm done with herding cats. I just want to sit in my room with 0 employees and just invest. And so I called our forum moderator. I said, my head is all screwed up. I don't want to go to work on Monday. There's nobody to resign to. I don't know what the fuck I'm supposed to do, because I'm ready to hit the reset button. So I had a nice session with my forum, and they said something really simple to me. They said, you can own the business without running it. I said, oh, why didn't I think about that? That's a great idea. And so they said, look, put a smile on your face, go back to work for 6 months, start a search for a CEO. In 6 months or less, you'll find the guy, hand over the reins, and then go to whatever hell you want to do. And so that's what I did. And I left the business, new CEO came in, and then about 4 or 5 weeks after that, he called me and said, someone wants to buy the company. And he had relocated from Dallas. My business was in Chicago. I don't want to pull the rug out from under him. So I said, I don't want to do anything here that is disruptive to you. What do you want to do? What would you like me to do? He said, sell it. So all his options, everything was going to vest on change of control instantaneously after 4 weeks of work. So, and the other beautiful thing was that the buyers wanted to lock him up. They wanted nothing to do with me. So they were going to give him a new deal, So he rings the register after 4 weeks, gets a new deal. So of course he's saying sell it, So we sold the business. And the only thing they asked of me, they said, we want to non-compete. That, you're not going to enter the IT business for like 4 years. I said, look, can we make it like 40 years? And we can add a few more million to the purchase price. They said, no, we just want 4 years. So I tried to get some more money for them, but I knew I wasn't going back to herding cats. So that's the story.
How did you 13x $1 million in 5 years? That's
Well, I mean, now that will get a little involved.
All right.
But basically, Buffett had a quote this year, and I think you saw the video, the Circle the Wagons video, right? So Buffett had a quote this year. I mean, he had a few sentences this year in his annual report. He said that in 58 years of running Berkshire Hathaway, most of my investing decisions have been no better than so-so. And he said there have only been 12 decisions that have been spectacular. So if I look at the 58-year history of Berkshire Hathaway and Warren Buffett and Charlie Munger, these guys are like the gods of investing. I mean, they're really good at what they do, right? The gods of investing are saying that they probably made about more than 300 different investments over that almost 60-year period. And out of those 300, only 12 mattered. So it was like a 4% hit rate. So now the other 296 were not losers. They maybe flatlined or did a little bit, but didn't really move the needle much. And so investing has this trait of where you can get, and you see this in your businesses as well, you can get outsized returns, right? But the outsized returns are not going to happen to every investment you make. And if I look at Warren and Charlie, I think they're like so good at what they do. 4% is a shockingly low number to do well at. But the ones that they did well on, those 12 decisions that moved the needle, those were just so spectacular. So in that period, when I had that 13x, there were 200 baggers, two stocks that went up 100x. Okay, in one case, I had put 100,000, and it was like 9 or 10 million. And the other one was much smaller. That was a overseas investment I'd done. It was only about 10,000, but that was about a 150x. That became about $1.5 million. And so if you take out those two, it's just ho-hum. 1 million becomes like 2-3 million or something. But if you put those in, it changes. And basically that has happened a few times. So, yeah.
A question. So for a room of people who are running their own businesses and betting on themselves every day, one of the things that I remember Buffett saying a long time ago is he knows what he does so much research, and wherever he's putting his money, he more than any of us could ever spend that time, or chosen to spend time doing that. So what's like, and I'm not gonna hold you to this, but like, if we were, your family members, and we all had businesses that were doing well and giving us outsized returns compared to the market, what kind of a ratio would you say, hey, you should take this percentage of your net worth and just leave, put it in an S&P and just don't even think about it. And then the rest of this, this best, your business best, keep pouring it back into your business.
Well, usually I think the issue you're going to run into, and you were describing your business to me briefly, but I think the issue most of you will run into is your business cannot absorb the cash it generates at high rates that it's already generating. So what I'm saying is the invested capital that you have and the cash flows that's generating is spectacular for many of you. If you were to put another 10 million in, you would not get a return on that because the business cannot absorb it, right? And because, like in your case, you're not in a capital intensive business. So even putting $1 million in is hard. What are you going to do? It's just difficult to spend them. So basically, I think in your case, or in many cases in YPO businesses, there really isn't a choice of putting it in the business because you're going to naturally see that. So a simple rule I would use is if I'm not getting like a 20, 30, 40% annual return by putting it into my business with a very low risk, I'm not interested, right? So if whatever the business can absorb at those types of returns, it should absolutely take that. The rest, index the rest, and you're done.
What was the hardest shift moving from operator to investor? Like did you find it as exciting, as rewarding? What was the hardest skill or discipline to develop?
My forum in Chicago, there was a really amazing retreat we had where we had these two industrial psychologists who had come in and they basically interviewed us all, interviewed our spouses, our employees, our friends, did full 360s on us, and basically they gave us what I call our owner's manual. They basically cracked our head open and said, this is who you are. And when they did that for me, they basically said to me that we have no idea, because that time I was still running the IT business. I was about to leave the business. They said, we don't even have any idea how you actually function every day with all those people and all of that. So they told me, you like to play games. You like to play math games. You like to play single player games. So they said, you're not the kind of guy who's happy being in a soccer team where you're one of the guys and the outcome depends on the team. So I like to play games where outcome depends on me. And so they said, the company you're running is just a ridiculous mismatch. And then when I described to them what I was just about to start Pabrai Fund, I described to them what I was going to be doing, they said, this is perfect, right? And this was 24 years ago. And one of them became one of my original investors. And I was telling him, listen, man, I haven't done this before. You don't want to do this. He said, no, we'll do fine. I looked in your head, I know what's going on, it's okay. And so when COVID hit and we had to work from home, I actually found that I was more productive working from home. And I'm actually really happy when I have no human interaction. I can deal with humans in very small doses. Like, after something like this, I need a long period with no humans, to kind of get back to square one. And so actually, for each of us, the answer is different. But for me, I found work from home is better. So I have an office in Austin. I stopped going to work. And it's so much better. I'm more productive. Everything is great. And all the tools are there now that we can do everything remotely. So from my point of view, I don't miss it at all. I think it's great. I don't want to do anything else. It's really good.
So one of the things like you mentioned was this 4% success rate on big wins. A lot of times we make investments in our businesses and we have to cut our losses. How did you go about thinking about when you pick a stock or an investment strategy, you say 96%, it's in the 96%, not the 4. How much time did you give it? What was your thought process on those things?
I mean, I think that's a great question. And I think the best answer I can give is when it's obvious. So you're going to know, you don't want to be trigger happy, but I would say in a few months, not a few months, in a 2 or 3 years, the writing should be on the wall. So once you own a stock, that's when you really start learning about a business. You don't really know much about a business before you buy it. It's only after you buy it. And when it drops 50%, you really become an expert at it. You know it really well. And so I think it kind of is obvious because you would know. I don't think you want to use the stock price to guide your decisions. It would over time become clear what the real economics and realities of the business are. And then you can just take it from there. So it's really important. One of the things I try to do before I buy anything is I want to be able to explain it to a 9-year-old in 4 sentences. What's the thesis here, right? It can't be a spreadsheet. It needs to be 4 or 5 sentences that a 9-year-old's going to understand. And so I have a very simple thesis. If, as time goes on, those sentences are no longer applicable, there's something flawed in the analysis I had done, then we need to move on. But it needs to be clear before you go in. I mean, I think you have clarity when you are running your business, you're making an investment, some CapEx, you have a lot of clarity about what you're expecting that to do. And you need to have the same clarity on the investing side.
I love everything you're saying, and it's so true. One of the things that you've been touching on, whether it's sort of in your stories about your daughters or you personally, has been sort of the golden cuffs you're able to put around either your compounding strategy or sort of taking the emotion out of, like, I've got to walk away from the snoozer or I'm okay, doubling down and concentrating and taking this much risk. I think that's one of the nuances that just like cannot get lost in the points that you're making, right? Because like the janitor, I love that story. One of the things that, I mean, he could have had more, you're right, but it was because he was able to put that money away and not go to Hawaii.
Yeah.
What you articulated. What do you think about kind of the behavioral, finance aspects? You clearly are able to cut your emotion away from the palpitations that sometimes I'm sure happens.
Well, I
What do you
think,
think about that?
I think for most of us, the answer is to just index. So I think that when you make the transition from index to picking stocks, that is a huge leap. And that comes with a lot of bells and whistles and caveats and thinking and whatnot. So I would say that the amazing thing about investing is that a know-nothing investor who just index, spends less than they earn, etc., will end up winning the race. And there's a reason why the index works. So if you look at the S&P, right? So S&P has 500 stocks, 500 companies. When you look at the individual names of these companies, they're very successful. I mean, that's how they got on that list. They make some changes to the index, like a couple of companies might go in a year and a couple will come in, but for the most part, it stays static, right? So what happens is that the index is too dumb to know that it owns Apple. It's too dumb to sell Apple. It's too dumb to sell Microsoft. It's too dumb to do anything. And so what ends up happening, if you think about the 4% situation, is there's a lot of companies in the S&P that will not do well. But those don't matter, because the thing is, it's got some that will do exceptionally well. It has NVIDIA in there, right? It's going to have the full run of NVIDIA, which nobody else is going to have. Everyone else will join that bandwagon after it's $1 trillion market cap. But it was in there in the S&P at 20 billion or 10 billion, right? And so it just had that entire run in the index. So the index is very powerful because basically you have ownership of some of the best businesses in the planet. And they're running and they're doing their thing and you don't have to think about it. And it's tax efficient and everything. So, like I said, there's 3 variables, right? So one variable that you just put that away. The other variable is, spending less than you earn, you have more control over that. And the runway, start as early as you can, So that's it, yeah.
So when you talk about the 100 and 200x investments, can you describe the asset class that those were in? And I say that because I'm typically the person that people invest in to try to get 100, 200x. So I'm just thinking, were those startups, were those venture, what type of investments could have that profile?
I don't take risk. I'm not a risk guy. So the things I invest in, if I were in real time to tell my investors what I was doing, they would throw up all over the place. Since you're not my investors, and I don't think you're going to throw up, but I can tell you. So, for example, 5 years ago, I started going to Turkey, Istanbul. And I had a I had a good friend there who basically is a hardcore deep value investor running a small fund there. And Turkey had a lot of dislocation. It still has a lot of dislocation with currency that's very unstable and mass exodus of foreign investors. So I told my friend Haider that, listen, I want to come to Istanbul and I just want to visit the companies that you actually have in your fund. Don't take me to any companies that you think are great and this and that. If you don't actually have your money in those companies, I don't want to see them, right? And so I went to Istanbul, and I think, and I've been going every year since, other than the COVID years. But in the second trip I made in 2019, he took me to see this company where the market cap was 16 million, 16 US dollars. As we were driving over, he tells me, Mohnish, the liquidation value of the business is somewhere between 600 to 800 million. So I said, is it a fraud? Like, what's going on here? What kind of people are running the place? So he said, no. He said, I have money in it. And he said, it's really simple. It's actually a REIT. Basically, they rent warehouse space out. And they're the largest warehouse operator in Turkey. They had 12 million square feet of Class A warehouses. I mean, their clients were Amazon, IKEA, Carrefour, Mercedes, Toyota, etc. 99% leased, inflation index leases, all of that. So I met with these guys, the father and son who run it. They looked perfectly fine, honorable people to me. I went and visited the warehouses. They looked exceptional, great locations. And I thought that it would be hard to get the stock because it's like such a nano cap. But Turkey is a interesting place because the local investors in Turkey have a complete gambler approach to investing. So their approach to investing is buy a stock at 10 o'clock, sell it at 3 o'clock, and make 10%. That's their model. Good luck with that, okay? And Buffett has a quote. He says that the stock market is a mechanism to transfer wealth from the active to the inactive. So I said, or like he said, it's like playing bridge with someone who doesn't look at the cards. So I said, if I'm going to be buying companies from these types of people, this will be a very fun experience. And I was very surprised. For $8 million, I was able to get 1/3 of the company. And basically, the trading volumes are really high in Turkey because of this. So if you take out what the insiders own and what the foreigners own, the floating stock cycles every 9 days. The entire company's market cap cycles every 9 days. In the US, it might be like 1.5 times a year or something for most companies, or 2 times a year at the most. Every 9 days is very hyperactive, right? So anyway, we bought 1/3 of the company, and I obviously in the last few years, been visiting them and know them well and so on. And a really great operator. So that 600, 800 million liquidation value is now approaching about 2 billion. It's been about 4 years since we bought. And the currency's collapsed. So when I bought, I was 5 lira to the dollar. It's 28 lira to the dollar. In dollars, the market cap now is 600 million. Still sitting at 1/3 of where I think it needs to be. But in lira, it's an infinite return, but who cares about that? So from my point of view, the father and son who run this are really smart. They're very astute capital allocators. We have no plans to sell that. And of course, the issue I run into is that it's become such a large portion of some of my funds that I have to keep giving disclaimers to all my investors that, like in one fund, this is not the only investment we have in Turkey, but all the Turkey investments are. So we had this type of a situation in Turkey because there was just a mass exodus going on, like people leaving and then the local market and all that. I own the Coke bottler in Turkey, which bottles in about 12 countries. And they also own the number one beer businesses in Turkey, 55% market share. And they have number one or number two market share in about 12 countries on beer, including Ukraine and Russia. And I paid nothing for those businesses. What I'm saying is I'm looking for no-brainers. I'm looking for places where there is a lot of irrational hatred and irrational behavior. And then when all of that, then we hone in on things that basically I can explain in 3 sentences. So that's what we do.
How much weight do you put on the macro? Like, so for example,
0.
Like, does the outside influence of like the Vanguards and BlackRocks on the S&P, does that concern you at all?
No, because the amount that's indexed relative to the size of the market is still small.
Right.
There are concerns with them about how they vote and things like that and all of that. They have some influence. But I don't think it matters in terms of how the investor is going to do. So, just if you look at the total amount in the S&P versus the total market cap, I mean the S&P index versus the market cap of the 500 companies is a huge delta. So it's okay. If that number started to converge, which I don't think can happen, I think it would take several decades for that to happen. But if that were to happen, then it becomes some issue, but not an issue right now.
How much of your investing, if any, has been in private companies versus?
It's all public. So it's all public because the thing is I cannot get these deals in negotiated transactions. So I think private equity is a very big industry in the US, and it has a lot of headwinds, mainly because there's too much money chasing. And anytime, I mean, all of you will see that. Anytime you are looking to put your company for sale, it goes into an auction. And then it gets bought at, I mean, who's in the title business? You're in the title business, right? You were talking about at the peak, all these guys sold, right, at peak valuations. Yeah. That's when the sellers are going to sell. They can see the peak. The idiot PE guys can't. And it's other people's money that they're playing with, collecting fees. So what do they care? You know. So I actually don't like to deal with private anything because usually I'm not dealing with someone stupid on the other side. You know, I like to deal with stupid people on the other side. You know, so. All right, thank you very much. Thank you. All right.